This is part one of a three-part video on purchasing a home. In this video, I'm going to explain what a mortgage is, go over some of the common types of home loans, and show you how to calculate the payments on those various types of loans. Hey everyone, this is Michael Todorich and thanks for tuning in. Just a quick note on the video before we get started. These videos are designed to complement my book, Running the Numbers, a step-by-step guide to life's major financial decisions. Each video corresponds to a chapter or section in the book, and the idea is to review the chapters and use these videos as a platform to add some additional color around the examples where it just wasn't practical to do in the book. So to check out the book or additional videos, please visit my website at michaeltodorichfinance.com, and there's also a link to the website and the book in the description below. So for many people, the purchase of a home represents a significant milestone in their life. However, home purchases are typically made infrequently and with large time gaps in between, and therefore for most people, the process is complicated and confusing. And in part one of this video, I'm going to first of all demystify what a mortgage is, and then I'm going to show you how to calculate the payment for each of the different types of common home loans, which are amortizing, adjustable rate, and interest only. And then in part two of the video, we're going to move beyond just the home loan repayment and look at all of the other expenses associated with the house and dive a bit deeper into the true cost of owning a home. And then lastly, in part three, I'll show you how to compare a 15 versus a 30-year loan and give you a framework to evaluate if refinancing makes sense for you or not. So what is a mortgage? A mortgage is usually thought of as the contract you sign when getting a home loan. But what you're actually signing are two distinct documents when you purchase a home. The first is the promissory note, and this is the contract you sign to borrow money. And this contract is going to identify the borrower, the lender, the amount of the loan, the interest rate, and the repayment terms. In other words, is it a 5, a 15, a 30-year loan, etc. The other document is the mortgage, and the mortgage provides security for the lender in case you don't repay your loan. And it basically says that if you don't repay the loan, the lender can come and repossess your house and then sell it to get their money back. Now, there are some nuances to exactly how a mortgage works in each state, but my description is generally accurate. However, I do recommend when actually purchasing a home, clarify with your real estate agent, as he or she should be able to walk you through all of the nuances specific to wherever you live. Now let's talk about the different type of home loans you can get. And there are a lot of different types of loans, but what I'm going to do is focus on the three most common, which are amortizing, adjustable rate, and interest only. So let's start with the amortizing loan, and this is by far the most common type of loan in the United States. And all amortizing means is that you're going to make monthly fixed payments for a period of time until your loan is paid off. And each of these payments includes a portion to pay down the principal and a portion for the interest. And you'll also often hear these referred to as fixed rate loans. And most commonly they're going to be for either 15 or 30 years. The next type is an adjustable rate loan, and this is actually a combination of a fixed rate and a variable rate loan. And similar to the amortizing loan, all the payments include a portion for principal and a portion for interest, but in an adjustable rate loan, the rate is not fixed for the entire loan period. And during the first period, and this is usually 3 or 5 years, your rate doesn't change, and it's actually usually lower than that for a traditional fixed rate amortizing loan. But once the fixed period is over, the rate will actually reset, and this is typically higher, to a predetermined benchmark plus some additional risk premium. And when the rate resets, it becomes floating and then will adjust periodically for the remainder of the loan term. And this type of loan is usually much cheaper than an amortizing loan during the initial fixed rate period, but it ends up being more expensive than the amortizing loan in the long run. And just to give an example of when someone might use this type of loan, I actually used to work for a company that relocated its employees every 2 to 3 years. And as the employees knew that they would only be in their house for a few years, most got a 5-year adjustable rate mortgage. And this would allow them to lock in a lower rate in the initial 5 years as compared to getting a 15 or either 30-year fixed rate loan. So they'd lock in that lower rate, and then they'd sell the house long before they ever had to worry about the rate resetting higher. Now, the last type of loan I want to talk about is an interest-only loan. And so with an interest-only loan, the borrower pays only the interest on the loan. In other words, unlike an amortizing fixed or an adjustable rate, none of the principal is paid down with the monthly payments. You pay interest only, and then the full principal balance is due at the end of the term with the very last payment. Now, as the monthly payments don't include any portion for principal, the payments are much cheaper as compared to amortizing or adjustable rate loans. Now, again, you may be asking yourself, well, who would use this type of loan? And this type of loan is popular, for example, with house flippers, as they only intend to own the property for a short period of time and they want to minimize the amount of their cash tied up in the flip. And these lower payments help to accomplish this because the house flippers make their money not through the principal paydown, but through capital appreciation, in other words, the increase in the home value when they sell. So now that we've covered the three main types of home loans, let's move on and discuss how to actually calculate your loan payments. And to do this, you're going to need three key pieces of information. The first is the loan amount, and just as the name suggests, this is just how much money you're going to borrow from the bank. The second is the periodic interest rate, and this is going to be the interest rate that's used to calculate your loan payments. Last is the number of periods, and this is simply the number of monthly payments that you're going to make over the life of the loan. So let's walk through an example of how to calculate each of these components using the following assumptions. So we're going to assume the home purchase price is $400,000. You're going to make a 20% down payment. Your yearly interest rate is 3%, and the term of the loan is 30 years. And the first thing we need to do is figure out the loan amount. And this is the purchase price of $400,000 minus the down payment of 20%, which is $80,000 for a total loan amount of $320,000. Next, we need to calculate the periodic interest rate, which is the yearly interest rate of 3% divided by 12. And we divide by 12 because the payments are made monthly. And that gives us a periodic interest rate of 0.25% or 0.0025 in decimal form. The last thing we need to do is figure out the number of periods. And because this is a 30-year loan with monthly payments, we multiply 30 times 12, which gives us 360 periods or 360 payments. So now that we have our inputs, we can calculate how much the monthly payments will be. And we'll first do this for the amortizing loan, as it's the most common type of loan that you'll usually see. And as I mentioned before, you will need Excel to do this. So let's actually jump to Excel, and I'm going to show you how to calculate the payment. So all you need to do is open a blank Excel workbook and click in any cell, and you're going to type in the equal sign and then PMT. And PMT is Excel's payment function. Then you put in open parentheses, and now Excel is going to ask you for the following inputs. So the first thing is the rate, which is the periodic interest rate of 0.25% that we calculated earlier. Next is the N per, which stands for number of periods, and we determined earlier that this is 360, so you'll put 360 here. Next is the PV, which stands for present value, and this just represents the present value of the loan, which we calculated earlier is $320,000, and so you'll input that here. Next is the FV, or future value, and as we intend to pay this loan off in the future value is going to be 0 once the loan is paid off. And then the last thing it's going to ask you for is the type. And what this is asking is if you're going to make your payments at the beginning or the end of the month. And unless you have a specific reason to choose otherwise, you always choose 0 for the end of the month. Now you finish the formula off by closing out the parentheses, you hit enter, and here you go. Excel has calculated your monthly home payment. So you can see for a $400,000 house with a 20% down payment and a 3% interest rate, your monthly fixed payment of principal and interest will be $1,349 for the next 30 years. Now, please keep in mind that this is just a loan payment, and I know a lot of times the bank will actually bundle home insurance and property taxes with your monthly payment, and this is exclusive of any of those costs. So we've calculated the payment amount via the Excel formula, but it still really doesn't give us a good insight on how the loan is actually paid down over time. And to understand this, I find looking at the detailed calculations to actually be much more helpful. So let's jump back to Excel, and this spreadsheet can be found on my website, michaeltordrichfinance.com, and let's take a look at how the loan is actually paid down month over month. So here you can see we're on the Amortizing Loan tab, and starting in the top left, you can see the previous assumptions that we went through. And you'll notice that there are yellow highlighted cells, and these cells denote input cells. And on every tab, there's an assumption section, and by changing any of the values in the yellow highlighted input cells, the calculations will update and flow through to the rest of the formulas. Now, just as an aside, and before we jump into the calculations, I want to note that I'm showing all the numbers rounded to the nearest dollar. In actuality, the loan payment is calculated down to the penny, but just to make the example a bit easier to follow, I'm only showing the numbers rounded to the nearest dollar. So let's start in period 1, that's the first month, and you can see that the beginning balance of the loan is $320,000. In the next row, you can see the interest payment of $800, which is the periodic interest rate of 0.25% times the outstanding balance of $320,000. And because your payment of $1,349 is more than the interest of $800, the remaining amount after the interest is paid of $549, which you can see here, actually goes down to pay the principal. And you can see that the principal payment is reflected in the end of period balance. In other words, the balance after you have made your first payment. And this will then come to $319,451, which is $549 less than the starting amount. So let's continue with this example and take a look at period 2. So you can see the beginning balance at the start of period 2 is lower than the beginning balance at the start of period 1. And that's because you paid down some of that principal in the previous month. Or to be specific, you paid down $549 worth of principal in that first month. And because the beginning balance, in other words, the outstanding principal left over on your home loan, is lower in month 2, the amount of interest that you pay actually decreases slightly to $799 versus $800 in the month before. Now, because less of your payment is going to interest, the amount of principal that you pay down in the second month actually increases from $549 to $551. And the amount of your payment that goes to pay down principal will continue to increase every month as your outstanding loan amount gets smaller and smaller. And as you can see, if we scroll to the right, the amount that goes to principal only increases by $1 or $2 every month. But if you fast forward to the end of the loan, in other words, closer to period 360, you can see that the majority of your payment at that point will actually be going to pay down the principal and very little going to interest. Next, let's take a look at an adjustable rate loan. And in this example, we're going to use the exact same assumptions as before. So a home purchase price of $400,000, a 20% down payment, 3% interest rate, and a 30-year loan. But we're also going to assume that the loan is a 5-year adjustable rate loan. In other words, the rate is going to reset after 5 years. So the initial monthly payment calculation is the exact same as the amortizing loan example, so I'm not going to repeat that math. And we know from the previous example, during the first 5 years or the first 60 periods, the payments are going to be $1,349 per month. Now, when the loan resets in 5 years, what the bank is going to do is they're actually going to calculate a new amortizing loan based on the outstanding principal at the time, the new interest rate, and the number of periods outstanding. So let's look at an example of what happens after 5 years or 60 periods when the loan resets, and we're going to assume that it resets to a 5% interest rate. And the first thing that we have to do is determine what the outstanding principal is. In other words, how much you still owe on the loan after 5 years. And to do this, we're going to use the PV or present value function in Excel. So let's jump to Excel and see what that looks like. So similar to before, I'm showing you how to calculate this in a blank Excel workbook. So click in any cell and hit the equal sign and then type in PV for present value and then an open parentheses. Next, Excel is going to ask you for the rate, and this is the rate of the current loan, which we know from before is 0.25%, so you'll type that in. Next, it's going to ask you for the NPER, and this is the number of periods left on the loan. And as 5 years have gone by, there are 300 periods left, so we're going to type in 300 for this input. Next is the payment, and this is just the payment from the original loan, which is $1,349. And also, just to be clear, you need to put a minus sign here because that's the amount that you are paying. Next is the FV, or future value, which is 0. And then lastly, the type, which is going to be 0 as well because you're paying the loan at the end of the month. So lastly, you'll close out the formula by adding another parentheses and you hit enter, and you can see that Excel calculates the remaining balance of your loan after 60 periods, and it's $284,500. And this is the amount that the bank will use as the present value for the new loan. So let's jump to the backup Excel again, and this Excel can be found on my website, michaeltolerance.finance.com, and you can see we're on the adjustable rate mortgage tab. So starting in the top left, you can see the inputs for the original loan that are used to calculate the monthly payment amount, which you can see here in cell B11. Next, if we jump to cell B14, this is where you enter the number of years until the loan resets, which is 5 years, and then the present value will calculate in cell B18. And then lastly, if we scroll down a bit, this last section calculates the new payment based on the new interest rate and outstanding amount. And you can see here in cell B23, it's pulling the outstanding amount of $284,500 from above, and that's going to be the present value of the new loan. Next, we'll enter 5% as new loan interest rate, and the number of periods of 300 is also pulled from above, and then the new monthly payment of $1,663 is automatically calculated in cell B29. So when the loan resets in 5 years at a higher interest rate of 5%, the new loan payment goes up to $1,663 from $1,349, or by a little over $300. And this process is going to be repeated every time the loan resets, and that frequency of resetting is going to be dictated by the specific terms of your loan. Now, the last loan we'll calculate is the interest only, and this data can be found on the interest only loan tab on the spreadsheet on my website. So let's actually jump back to Excel and take a look. And to calculate the monthly payment for this type of loan, it's simply your monthly rate times the principal balance. So using these same assumptions as the amortizing loan, we'll assume a $400,000 purchase price with a 20% down payment, a 3% interest rate, and a 30-year loan. And we'll divide the 3% interest rate by 12 to get a periodic interest rate of 0.25%. And if we multiply that times the $320,000 of principal balance, that'll give us a loan payment of $800 per month. And remember, the $800 per month is only the interest portion of the loan amount. No principal is being paid back here. And as you can see, you continue to make that payment for 359 periods, and then the very last payment, payment number 360, is going to include that interest of $800 plus the full repayment of the principal amount of $320,000. So the very last payment is going to be $320,800. So that takes us to the end of part 1 of chapter 8. And if you like the video, please don't forget to subscribe and hit the like button. And then in part 2 of the video, we'll look at all the other expenses associated with the house and dive deeper into the true cost of owning a home. And for more information on the book or additional videos, you can check out the links in the description below or on my website at michaeltolerance.finance.com. Thanks for watching.